Every business, every bank, every family loan, even the price of your morning coffee, is secretly linked to one small number. It's a number that moves the stock market, decides housing prices, and shapes the destiny of entire nations. That number is called the interest rate. It's the hidden switch behind booms and busts, and in the next 6 minutes, you'll see how it works, how it affects you, and how the world moves when this number changes. In simple terms, interest is the cost of borrowing money or the reward for lending it. When you deposit money in a bank, you earn interest. When you take out a loan, you pay interest. It's the price of time. Because money today is always worth more than money tomorrow. Time itself has a cost. Interest rates measure that cost, balancing the desires of borrowers and savers. It's the silent transaction that keeps the world's financial engine running, a constant negotiation between now and later. Interest rates are like the economy's temperature. When they're low, borrowing gets cheaper. People buy more, companies invest, and economies grow. It's a season of expansion and opportunity. But when rates are high, borrowing slows, spending falls, and growth cools down, bringing a necessary moment of caution. Every central bank uses interest rates as a thermostat, attempting to keep inflation and growth in a delicate balance. The invisible truth is that interest rates don't just affect money, they shape emotion. They decide whether people feel bold or cautious, generous or afraid. When a central bank changes its main rate, a massive chain reaction begins. First, banks adjust their lending costs. Then, businesses rethink their investment plans. Consumers recalculate their mortgages and car loans. Investors rapidly reposition their holdings in stocks and bonds. It's a domino effect that can shift trillions of dollars overnight, all triggered by a change of just a few basis points. These are tiny numbers, but they create massive ripples that travel across the entire financial ocean. So why does interest even exist? It comes down to one fundamental human truth. People value the present more than the future. We'd rather have $1 today than $1 a year from now. Lenders demand compensation for the inconvenience of waiting to get their money back. Borrowers, on the other hand, are willing to pay for the convenience of having that money right now. Interest is simply a trade between patience and urgency. When you truly understand this, you realize that interest rates aren't just about math. They're deeply rooted in human psychology. They represent the price of trust across time. Low interest rates encourage borrowing. They make homes more affordable, they fuel startups with cheap capital, and they drive consumer spending. Economies thrive in this warmth, but sometimes too much warmth can breed dangerous bubbles. When money becomes too cheap, people stop asking if something is actually worth buying. They just buy it because they can afford the loan. Low rates ignite powerful growth, but they also have a darker side. They invite greed and reckless speculation into the market. Rising rates are like winter for the economy. They cool down overheated markets, reward diligent savers, and slow down speculation. But if rates rise too far or too fast, it can create a harsh frost. Businesses struggle with higher borrowing costs, jobs may shrink, and nervous investors retreat to the sidelines. High rates are essential for restoring balance and discipline, but they also expose the weaknesses that were hidden during the good times. The world needs both seasons, one for growth and one for reflection. In our deeply connected world, no nation moves alone. When one major economy, like the United States, changes its interest rates, capital flows shift globally almost instantly. Investors move vast sums of money across borders, seeking higher returns. Currencies strengthen or weaken in response. Global trade adjusts, prices respond, and the entire system seeks a new center of balance. Interest rates are no longer just a national concern. They are global vibrations that can be felt in every corner of the market. So how do interest rates affect you directly? Every major decision in your financial life carries an interest rate shadow. The rate on your loan defines what you can afford, whether it's a house, a car, or your education. The rate on your savings defines what you can earn and how quickly your money grows. Your investments depend entirely on where that balance lies. When rates rise, safer fixed-income assets like bonds become more attractive. When they fall, riskier assets like stocks or real estate tend to shine. Understanding this dynamic helps you position yourself wisely instead of just reacting blindly. Beyond the numbers, interest rates also reflect the national mood. Lowering rates sends a signal of optimism. We want growth and expansion. It's a green light for the economy. Raising them, however, signals caution. We must protect value and control inflation. It's a yellow light, telling everyone to slow down. People respond to these signals emotionally, even if they don't consciously know why. You feel it in the buzz of a hot housing market, in the availability of job offers, and in your daily spending habits. Money is emotional, and interest is its rhythm. Wise investors don't fear rising or falling rates, they adapt. They've learned to see opportunities in both seasons. When rates are high, they seek the steady yield and safety of bonds and high-interest savings. When rates are low, they seek growth and expansion through stocks and other assets. The key is not to waste your energy guessing the next move. It's about preparing your portfolio for every possible move. In a world where time has a price, patience is profit, and time is the ultimate teacher. Interest rates are not just numbers on a screen. They are the heartbeat of our civilization's financial body. They remind us that money has a rhythm, and that rhythm is tied directly to our choices, our collective decisions between saving and spending, between fear and faith. When the rate rises, breathe deeply. When it falls, act wisely. Because in the end, wealth belongs not to those who guess the rhythm, but to those who learn to move in harmony with it. Thank you so much for joining me on this journey. If you found this valuable, please give this video a like, and consider subscribing for more insights into the world of wealth.